I want to talk about the hedge analysis tool. One of the reasons that we made this was it was actually born of this thing that I had been writing about it back in the middle of all the chaos, but I thought I had written my argument for it and all that, so I won't rehash it all. But I thought that the VIX, the deferred VIX futures, like 2-month VIX future, they look too cheap to me relative to where spot, like when SPY had sold off. So the trade that I liked doing was I bought S&P futures and I bought the VIX futures together. And my thesis was not that the market's undervalued or anything like that. It's just that I think that the VIX future I think that the VIX future is cheap given where the SPY was. That basically, if they were to both go up together, if the market was to go up, I thought that the VIX future would not fall because you would expect the VIX future to fall as the market went up. But I thought the VIX future was cheap enough where its downside was roughly bounded at like 20 and the SPY could go up a bunch. And I think that the risk premium would kind of stay in the market in the VIX future, which is essentially what happened. I'll admit that I closed that position too early, but it made money and I was right, but I just closed it too early. But this tool was born of that idea, which is, hey, I want to buy both. But what's the right ratio to buy them in? I mean, you don't know exactly what the right ratio is, but you need to get to some answer that's reasonable. It comes down to how much do I think those VIX futures move relative to SPY? Like if SPY is up 1%, what do I think the VIX future does? What's its beta? And we don't have VIX futures in the tool, but we have VXX, and VXX holds the 1-month future. I traded the actual 2-month VIX future, but VXX was a reasonable enough proxy for what I wanted to do to compute that ratio. So what I did is I said, okay, let's say I've got 1,000 shares of SPY, and I've got and my hedge asset is going to be VIX. In which case, because it's negatively correlated, instead of buying one and selling one, you're going to be buying both because we do know that VIX is anti-correlated to SPY. So you put them both in and you just hit the calculate hedge analysis and it gives you all this stuff down here. And I just want to look at that real quick. You've got your correlation. So first of all it's doing is it's saying what is the daily returns of SPY on the x-axis. I'm calling SPY reference asset, but you can think of that as that's your independent, right? And then your dependent. So the idea is like if SPY up 1%, how much does VXX move? And then how much of the VXX move is like explained by SPY? Right. That's really the the English behind the math, right? So the SPY daily returns are on your x-axis, independent. Your y-axis is the VXX daily return. And we can see this relationship here. And what we can see is that they're anti-correlated as we expect. And so we have a negative 0.8 correlation, but we want to turn that into a beta. So because correlation is not like what correlation says is if SPY is up 1 standard deviation, that VXX is down 0.8 of its own standard deviation, which is like a pretty unnatural number to most of us mortals. So we turn that into a beta, and the way you do that is you just multiply that by the ratio of the vols between SPY and VXX. So, and the calculation is explicated in the tooltip. So you can see the SPY vol is 0.013, meaning 1.3% per day over the look back period. The VXX vol is 6.12% per day, and the correlation, and we just take the vol ratio, multiply by the correlation, and we get the beta. So the beta is a very natural measure to us. It says, hey, if SPY is up 1%, then I expect VXX to be down, because it's negative, down 3.79% or 3.8%, whatever. So SPY up 1%, VIX will be down 3.8%. That's what it says. Now we have to multiply that beta times the prices of, SPY and VXX are not the same price. So we have to multiply that by the price ratio between the two. And that's how you end up with a hedge ratio. So what this ends up saying is that if I buy 1,000 shares of SPY, I need to buy just about 3,000 shares of VXX. And I think I'm hedged. Like basically it's like no matter what the market does, I think that I'm roughly hedged. Now my thesis here was that we're going to do better than this, that we're not really hedged, and it's like this portfolio is actually going to accrue some value over time because the VXX is going to outperform SPY. So you put the trade on, and then like you feel like you're hedged, but you're not fully hedged, right? There's variation, there's error in that relationship. And that's actually what this Idio means. I won't go through the computation here, but what the Idio is saying is like, hey, if SPY is $600 and you buy 1,000 shares, this is a $600,000 position. Let's just say that your daily standard deviation in SPY is, I'm just going to say it's 1% just to make it easier. That means that if you have a $600,000 position in SPY, on any given day, you expect your standard deviation of P&L to be about $6,000. But when you put the hedge on, right, it doesn't go to $0 because it's not like you bought inverse SPY. There's a lot of wiggle room even in this relationship where you think you're hedged, but there's error around it. So what this is saying is your Idio that's remaining is 60% of the volatility of the asset. So if you thought your daily standard deviation was $6,000 when you were unhedged, now it's $3,600. You've cut it to be only $3,600. Notice you did not cut it to zero. You cut it to $3,600 of daily volatility. That's how much risk is remaining in this spread that you've put on. So you're hedged, but you still have $3,600 of error around this hedge. That's what that means. So anyway, this whole tool was built out of the idea is if I want to buy SPY and VIX, what's the right ratio to put them on? And then the Idio gives me an understanding of how much risk I still have remaining after I put that spread on. So I think I'm hedged, but if my P&L varies by $3,000, I'm not shocked. I mean, that was within a standard deviation of how much Idio I had, right? So it's a you have an understanding of like a sense of proportion around what your risk is in the spread. Down here, we can see, remember, this was all driven by your correlation, but this is over the full sample. This is a year's worth of data. Remember, 365 days. This is over your full sample. And you had an 80% correlation here. But correlation itself is volatile. So if we look at that's for the whole sample. If we look recently, this is your 21-day correlation. You can slide this to sort of any number, right? 21-day correlation, rolling correlation, and you can kind of see that we have the Idio up on the top, which is mechanically derived from whatever the correlation number. The correlation is an empirical number. The Idio is just a formula based off that. So the correlation, we can kind of see that we've had a correlation of negative 0.6. That was when the correlation was the weakest. It was 0.6. And then, we get some strong correlations of a negative 0.9. So recently, the correlation over the last 21 days has been about 90 core versus the full sample where it was 80 core. And notice, just kind of testing yourself a little bit, if the correlation here were higher between the two things, then you would have, this is correlation times the vol ratio, your beta would be lower. Your beta would be lower and you would have less shares to buy to be hedged. So and this is your rolling beta. So this is probably even a better thing to look at if you're looking at the time series, because, again, the correlation is kind of a hard to interpret number to some degree, and the beta is probably more what you care about. So you can see that the beta between like how much you would have hedged has varied between a number like beta of 2.2 and then the highest beta you got was a beta of 8. This is a massive beta. The VIX was super. Oh, this was back, and remember, this is 21-day trailing. This is catching August 5th. You remember August 5th? And that was the whole August 5th episode, I mean, showing up right here, the whole August 5th episode was that there was a concentration of risk specifically in the vol market. August 5th was a tail wagging the dog situation where the vol market kind of was where the stress was originating from. And that's why you got this giant move in vol relative to SPY, right? Or vol overreacted, you could say, compared to like what the SPY move was. And you had this giant blowout in beta, and that's kind of shows up in the August data. But the typical relationship here is like you can see right now, actually, the vol is quite sensitive, more sensitive than normal over the last year to SPY. You have a beta of 4.8 versus a full sample beta of 3. So that's so this is the hedge analysis. I hope that was kind of helpful as to why I even made this, why we